Welcome to our RaboResearch Food and Ag Reports on Brownfield. I'm anchor reporter Megan Grebner, and with us is Don Close, Senior Animal Protein Analyst with RaboResearch. Good afternoon, Don.
Hey, Megan, how are you?
I'm doing well, thank you. Today, we're going to talk about the latest RaboResearch Food and Agribusiness Report, and this one focuses on feeder cattle basis. So let's start with a summary and some of the highlights from the latest report.
Okay. This report's a little bit different on how it came about, because this one was specifically done on request from customers of the bank that as we went through the huge price rally in 2014, 15, and all of the cow-calf producers and the stocker guys all hedged too early. They left money on the table, were frustrated. And then we're there second half of 15, early 16, and that break in the market clearly way deeper than anybody was prepared for. So with that volatility of record tight supplies of cattle and then to a really rapid buildup in numbers, they just felt caught in the crosshairs. So they were asking us for if we could look at it. The first real thing that we did different in this report, and we've created an ongoing product for customers, is we've split the basis up into regionalized basis. We tried to match up those geographic regions that the cattle type fit the best, geography fit the best, transportation to the major feeding areas as similar as possible. So with the 12 states that make up the CME feeder index, we've divided it into 5 regions. Region 1 is Montana and Wyoming. Region 2 is Nebraska and North and South Dakota. Region 3 is Missouri and Iowa. 4 is Kansas and Colorado. And then Region 5 is Texas, Oklahoma, and New Mexico. So what we're trying to do with that is we're simply trying to make a one-stop location to simplify that a customer that wants to monitor basis but doesn't go through the hassle of recording prices on a daily or weekly basis, we're providing that service for them. When we do it that way, we're also able to take the percentage of cattle of each region that make up the index on a daily and weekly basis. So it's not only important that a producer look at what's the price difference of cattle in my geographic area to the CME, but he can also look at what percentage of the cattle in my market area make up the entire index. And where we're at with that is a good share of the year, Region 1, again, it's Montana and Wyoming, it will typically represent less than 10% of the cattle that are in the index. On the other extreme is Region 5, would be Texas, Oklahoma, New Mexico. That area will typically make up as much as 60%. So a producer in Montana will say, that index doesn't look anything close to the prices in my area. Well, number one, they're predominantly calf sellers, so they're not big yearling sellers. Cattle quality is extremely high, and given where they're located, opposed to the number of cattle going through Oklahoma City and the OKC West markets that make up the volume. So that producer can get, okay, it's going to take a really big price change in Region 1 to have a significant impact on the index, where a reasonably small price change in Region 5, that's 60% of the volume, it doesn't take near as much price change there for those cattle to be reflected in the index. So the takeaway there, and each one has their characteristics, stability of prices day in, day out. Region 3, that's Iowa and Missouri, really has the most consistent basis throughout the course of the year. The the most reliable because of this whole volume thing we've talked about. The South Plains guys, the Texas, Oklahoma, New Mexico, they have the largest share of representation and should, because of that, have the most reliability of basis matching up the cattle they're selling.
Does this also play into our risk management? And with the volatility we've seen in some of the markets lately, how does that play as producers are trying to stay as profitable as possible?
Sure. One of the things that we've looked at, and it's a huge frustration for producers, you know, they're very quick to talk about it, but as cattle prices have escalated over time, and even though we've set back some, we're still looking at historically very attractive prices. But if you look at basis as a percentage of the underlying cattle value, so as cattle prices go up, the volatility or the change in that basis goes up as well. So as cattle prices go up, the amount of money required, or the capital, access to capital required to implement a hedge program, it goes up as well. So as cattle prices escalate and a guy's pulling on as much as his capital as possible to buy cattle, at the very same time, his cost of risk management goes up at the same time. So he's being pulled on both ends of the candle, so to speak, to meet all his obligations, and it takes away from resources he has to buy desired numbers of cattle when prices are high.
As we look at the report, Don, and kind of wrap up our conversation about it, what are some things that producers maybe need to keep in mind as they're looking, whether it's risk management or they're looking at some of these news and information nuggets coming out of this report?
A real takeaway that we found with the research that we did, with so much of the market activity, market positions today are held in some type of a spread position, that either they're in live cattle spreads or cattle feeder spreads. And as a result of that, we've had a big resurgence or popularity in the cattle crush spreads. That's where you're buying feeder cattle, buying corn, selling live cattle. So you've got a paper, you're feeding cattle on paper. And you can trade those spreads, you know, trade them up and do a reverse crush spread when the margins aren't there. But because of that, the deferred live cattle contracts and the feeder cattle contracts, the open interest difference between live cattle futures and feeder cattle futures is about 14 to 1. So it doesn't take a whole lot of activity in the deferred live cattle contracts that are 14 times the size of the feeders, but a spreader has to get those equal numbers of contracts on the books. So a small ripple in the water in deferred live cattle futures can be a tsunami in feeder cattle futures just because of the pressure of the spread trade and the imbalance in open interest. So that's a real takeaway. Because of that, those crush spreads have a timetable on them, and as we get to a point roughly 120 to 150 days before expiration of the feeder contract, well, they're no longer viable as part of the crush trade. So as those cattle crush spreads unravel at clearly between the 120 to 150 days to expiration, there is and time value becomes less of an uncertainty. So the volatility in feeder cattle futures has a clear turning point in that 120 to 150 days to expiration. Our takeaway from that is we have recommended to customers, look, if you're needing to hedge in those deep deferred feeder contracts, use a soft hedge, use some kind of an option strategy, but do something that you have a limited amount of risk exposure and a high degree of transferability. Once we get to within 150 to 120 days to expiration, if you have a profitable position, you like what you see, roll that position into a net futures position at that time. So that's really a key takeaway of the timing of when and what kind of strategy to have in place.
Tom, I think it's appropriate. We're at the end of 2017. It's hard to believe we're heading into a new year already. The latest cattle on feed report came out just about a week ago. A couple surprises in that. To put it lightly, just a couple surprises. As we wrap up this year and we take a look into 2018, where are we going? And especially with this large amount of cattle that's in our future.
Right. And we do have a lot of cattle on feed. Now, I think a real critical component of that, when you look at a 13% plus increase in placements, the initial response is to panic, but there was clearly a huge weight distribution factor that the majority of those placements were lightweight calves, that we haven't seen that many calves on feed in quite some time. The availability of the weather conditions across the hard red winter wheat area, there is no wheat pasture. So those light calves were forced to go into the feed yard early. I think that's a positive. One is it takes a lot of the sting out of it, that we won't see nearly as many of those calves back on the market as fed cattle as quickly. The other thing is, typically when those cattle are placed that light, there's a tendency for them to finish lighter. Some of that can be compensated with implant strategies, but it's still true that placed light usually means lighter outweights. But the other thing is, with that many light calves, and will be on feed 180 to 200 plus days, there's a real tendency for those calves, different management styles, different feeding regimens, for those cattle to be spread out. So because of what those placements consisted of, I don't think there's near the threat of bunched marketings as we would normally have with that big of a placement number.
Do we also, you and I talked about this before too, slaughter capacity on the beef side of things? Do we get a little nervous with these light calves maybe coming to market at a time that puts a little bit more pressure?
I think that's a great question, and I think it is valid. Now we've seen throughout 17 that slowly but surely packers are, as they have ramped up staff and those long-standing employees in the plants have got conditioned for working additional hours and working with faster change speeds. They've been able to ramp up slaughter, pretty well throughout the year. I think the really timely part of your question is, I'm not so sure that we will hit that wall on slaughter capacity, but I think the biggest risk we have at hitting that wall on slaughter capacity will be in that August to October time window, and that's exactly when a lot of these calves will be timing to come out. So yeah, that's going to be a big lookout as we go through 2018. The other thing, when we talk about large cattle supplies, we really need to acknowledge the fact it's not just cattle. We've got a big growth curve. We've got all the new production facilities on the pork side that will be going into full production in 2018. Indications are we'll see a more aggressive growth curve in the broiler space than what we thought early on. So total protein supplies are going to be a big issue in 18.
Do we watch maybe the competition within proteins, because there's a record supply of poultry? Does that maybe pressure those pork and beef prices that have held on so well really through these larger and increasing?
Well, the other
production
side of this thing that really needs to get attention is, yes, we have a lot of meat, and not, again, on all species, but we're continued to see incredibly robust demand, both in the domestic market and especially in the export market. We're going to end up with growth increases in export tonnage for 2017, about 12 to 13% up for the year. This will be the first year in history that beef exports will have exceeded more than 10% of production. We're right at 11%. So as long as that export pace holds together, as long as our domestic economy is as assertive as it has been, and indications are that that will certainly continue through 18, if not well into 2018. So I think we've got that demand base that will offset a portion of this. If you look at that competition between the species question, certainly the very attractive price of feed grains that we've seen throughout 17 and look like we'll have with us through 18 still gives big advantages to the beef side, just on the on using more bushels of corn per animal. So I still think the market's in really good shape. Your point, will prices be softer than they were in 17? Most likely so. But in no way do we need to look at this supply of product just going to be a ruination or a wreck in the market. I don't think we're there yet.
So we could see another good year for livestock producers in 18.
I think so. And again, I think it will be a little slower pace, a little lower prices than what we saw in 2017, but on a cost of production or a profitability basis, I still think things are overall quite favorable.
I thought it was interesting as we looked at net farm income for 2017, livestock producers really provided a lot of support on net farm income, and that looks to continue into next year.
It sure does. And what we're seeing, if you look at the distribution of those placements, we're seeing a lot more cattle go into the traditional Corn Belt states. A lot of evidence that the guys who are so frustrated with the inability to profitably sell corn and or beans right now, that their plans are to walk a lot more of that corn off the farm with livestock. I think from that spin, we're going back to a very historical production model that we haven't seen in quite some time.
Talk to me a little bit about the demand picture. You mentioned domestic demand needs to hold on. We need to continue, obviously, to grow our export demand and our international or our place on the international marketplace. We know China has a lot of growth potential.
Yes.
Are there any other countries that we're looking at that could be big players for beef and pork and U.S. proteins in 2018?
Well, let's split those. Let's talk domestic and let's talk export, because you kind of two different questions there. We've seen just the last couple of days the consumer confidence scores down a little bit in December from where they've been, but still very, very good. You've got the Dow still making record highs, almost during the day. You've got housing sales pace and housing prices the highest we've been in years. The unemployment rate at 4.1. They're just, all of the signals are giving consumers a tremendous amount of confidence currently, and they're demonstrating that confidence by spending money at the meat counter. And say all of those measurements at least this juncture still look very good. So, okay, domestic, I think we're okay. On the export front, we certainly need to be anticipating a higher level of competition, specifically from Australia in 2018. I think they're getting some stability back and the ability to rebuild some herd numbers down there, that they should be a bigger competitor. That will show up in both Japan and South Korea. So we could see, I don't think we'll see another 13% increase in export sales. The number that I have used, though, is I'm still looking for a 7% increase in export growth for the year. So on a historical basis, that's still a really robust number. China is the huge wild card. Now we're seeing sales increase already, and we had the announcement earlier of JD.com and with the Montana stock growers and their memorandum of understanding trying to get Montana beef to China. I think that will be just the first of many similar announcements that we'll see. But when we're looking at a 3 to 5 year timeline before we really see that export pace to China reach a critical mass. So we will have that big uncertainty for not only 18, but probably 2019 and 2020 of, yeah, but we've got this 900-pound gorilla that could come into the market on any day. So that will continue to be a huge bright spot for the next several years.
Don, anything else? Any other insights as we look ahead to 2018 and start the new year?
I think we pretty well touched on it, but we talked briefly, with the projected ending stocks on corn at 2.4 billion, wherever we end up on corn acres for the new year, but just we're going to be blessed with very large feed grain supplies throughout 2018 and probably extending beyond that. So on the cost of gain side, still looks very, very attractive and manageable levels for producers. I think we're going to be back in a very classic market where management on getting feeder cattle bought right, really tight management will be the make or break point on whether the cattle are profitable or not. The volatility issue that we started this conversation with, that's still going to be there. So producers really need to do keep a sharp eye on what their risk management opportunities are. But from there, I think that the market looks okay.
Don, thank you very much. Have a happy new year.
Megan, it's always fun. See you.
Good to see you. I'm Megan Grebner for Brownfield.